Should you borrow to invest? Everyone has an opinion on this. Ted is here to discuss it, starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
My goal on this podcast is not just to share my opinion. I guess that's my main goal, actually, is to tell everyone what I think. But I also want to present alternative viewpoints so that you, the listener, can make up your own mind. Of course, my biases are pretty clear. Y'all remember Straight Talk on Your Money, that book I wrote, still available on Amazon and Kindle. Chapter 13, I said, I don't think of a house as an investment. I think of it as a consumer good, like a toothbrush. You use it, you throw it away. But I get it. Other people disagree with me on that, so we're going to hear them. Today, we'll discuss whether or not you should borrow to invest. So let's start with the biggest investment most people borrow to make in their life, and that's a house.
Okay.
So Ted, welcome back. Explain to me why people disagree with me and believe that a house actually is an investment.
Well, the common view is that you've got this asset that you purchase, and over time, because they're not making any more land and inflation drives prices of everything up, that asset's going to go up in value. So unlike something that you consume, like a toothbrush and throw out, the house is still going to be there in 3 months, 6 months, 9 months, 12 years, 20 years. And experience has shown over time, it goes up in value.
So that's the definition of an investment, something that goes up in value. And the reason I don't think you should think of it as an investment is because it costs a lot to have a house. You got to fix the roof and do this and do that.
Well, years ago, we did the math. We thought that home ownership costs you 25% more per month per annum than actually renting.
Yeah, and with the market being what it is, who knows?
I don't know if that numbers are accurate anymore.
Could be completely different. So, okay. Then the question is, does it make sense to get a mortgage to invest in a house?
So it depends on what you mean by sense. I'm beginning to sound like Bill Clinton now, right? Because housing costs have gotten so high, very few people could afford to get into the market if they had to save enough money to actually buy the house. I mean, well, let's go back post-war when you could buy a house for $3,000, $5,000. You're only making $10 a day, so it's still a big number. But it's not like today where you've got to have $500,000 to buy a house, at least. Well, $500,000 to buy a condo anyway. So as long as you've budgeted properly and the payment is affordable, then it makes sense to get a mortgage. If you're going to wait until you have enough cash to actually buy the house, I'd be willing to predict you're not going to buy a house until somebody dies and leaves you the money.
Yeah, and Nazma Ali was on the podcast a few months ago, and she said exactly that the only way you're able to buy a house is if you sell the house, you've got to buy another one, or your parents give you money.
Well, yeah, and my guess someplace out there, somebody's already predicting what percentage of new home buyers now, they're buying it because somebody's giving them the down payment. Yeah, nobody's saving it anymore.
It's a significant number. So, okay, so let's get back to the topic of the show here. Should you borrow to invest? So your answer is if you're borrowing to buy a house, and if you consider a house to be an investment, then yes, it's okay to borrow to invest. But what caveats would you like to put on that statement?
Well, the biggest one is it's got to be affordable. I mean, it's getting lots of media coverage right now on all the mortgage testing that the government put in place a few years ago. I mean, how does it work? You're calculated, can you afford the payment at X interest rate, which is higher than the current interest rate, based on a certain formula. The goal being that people can't overinvest in their homes or buy more house than they can afford.
Yeah, and the stress test has kind of come under a bit of stress because, of course, interest rates have come up and the stress test hasn't necessarily kept up with it.
And the values are moving at too ridiculous a rate that none of it makes sense anyway.
Either up or down. But I agree with you. Affordability. Can you afford it? What will the mortgage payment be? What will everything else be? Can you afford it?
Well, and the other aspect of that is how long are you going to keep it? So, I mean, I've told you, when we moved into the house that we're in now, I told my wife, we're going to die in this house.
We're going to die in this house.
I'm never moving again. I've had enough of this crap.
You expect that will be many years in the future, right?
That's right. Well, unless she puts a pillow on my face, but that's a different conversation.
Could happen.
If your intention is to buy a house and then, sell it next week, that's a different conversation.
Yeah, and that's not an investment so much as speculation.
Right. Well, it's an income property of a different type.
Yeah.
Right?
So yeah, I think the answer is, okay, you can't afford to buy a house with the cash you've got. You're going to have to get a mortgage to do it, make sure it's affordable, and take a look at the timeframes. And the reason the timeframes are so important is because house prices go up and down.
Correct.
And I did some research on this. I'll put the chart up on here. The housing market in Canada peaked in the first quarter of 1989, and I remember that because I bought a house in 1989, and the prices did not get back to that same level until the last quarter of 2003. Think about that. 14 years. Now, I realize that's, ancient history.
Right.
So was it a good idea to invest in a house in 1989? Well, I guess if you were going to live there for 20 years, it didn't matter. It doesn't matter what the price is. But if you were planning to flip it a year later, you would have lost money. Now, that's houses. That's not really what people think of as investing. People think about stocks. I'm going to buy stocks. I'm going to buy stocks in the stock market. So same question. Is it a good idea to borrow money to invest in the stock market?
So it only makes sense if you can afford to lose the investment. So if you're going to gamble on the stock market, and that's what I consider the stock market to be, you're gambling. Speculation is your term. You've got to be prepared to lose whatever it is that you're spending. So if you're going to borrow money, let's say you're going to, I don't know, pick a number, $50,000 to buy whatever stock is fashionable right now. Let's not talk about crypto today, right?
Nortel? Oh, no, wait a minute.
Nortel, that's a good one,
That's not a stock anymore.
Most of the people listening won't remember what that is.
No idea what I'm talking about.
But anyway, if you're going to borrow to invest in the market, then you've got to be prepared to lose that investment because the market goes up, the market goes down. You're still going to have to pay back that $50,000. And so the question is, as soon as you start seeing it go down, do you immediately sell it? Okay, so now you're crystallizing your loss. So it's gone down, you're below, you're afraid, sell it all, pay off as much as you can, and then you minimize the loss that you've already experienced, or do you ride it out hoping that it'll go up again and that you won't have any loss?
This is the question. So there are three ways to invest in stocks that I can think of. The first one is, you save money and then you buy the stocks. You're not borrowing anything. Cash. You pay cash. So and the most you can possibly lose is whatever you put in.
Right.
The second way is with leverage, where you go to the bank and say, hey, can you give me a loan? Or I use my line of credit and I put that in stocks.
Right.
And the third way is you buy on margin, which means, what does buying on margin means?
You're basically saying, I'm going to predict what the price is going to be, right?
Yeah, and it's your stockbroker who's giving you the money, who's loaning you the money.
And as long as the stock goes up, everybody's happy.
Yep. And if it doesn't, they don't. So let's do a mathematical example here. So let's assume that the margin rate is 30%. Mm-hmm. So that means you're putting up 30% margin. Your stockbroker is going to lend you 70% of what you're paying. So you purchase 1,000 shares. Mm-hmm. The stock's $50, margin rate of 30%. So walk us through how the math looks on this purchase.
So you've got 1,000 shares, $50 a share, $50,000. 30% of that's $15,000.
So I got to put up $15,000,
and the broker's going to put up then $35,000, and
that totals the $50,000 I'm buying.
Right.
Okay. Cool. So you can log into your brokerage account and see what the margin is required for various stock purchases because it'll be different.
Right.
The highest leverage or the highest margin is around 30%, which means I only have to put up 30%. And that would typically be for, if you're a rich guy, you've already got a couple of $1 million in your account, or it's a blue chip stock.
Yeah, you're buying bank stock.
You're buying bank stock, something like that.
Maybe utilities.
Which, if the stock is trading at more than $5 a share, then it's, for margin requirements, considered a blue chip. If it's under $3 a share, there's probably no margin ability. It's a penny stock. You can't get it. So they're not going to lend you money to buy a penny stock. So, there's two things that can happen. The stock goes up or the stock goes down. So,
or it could do nothing.
Or three things. There could, but we'll ignore that one. So let's assume everything goes great.
Yep.
Stock doubles in value. It goes from $50 to $100.
Right.
And if I paid for the stock myself, didn't use any margin, how much money did I make?
Well, you spent $50,000 to buy the 1,000 shares at $50 a share. You're selling those shares now at $100 a share. You just made $50,000.
I doubled my money
before you paid the taxes
and the commissions and all the rest of it.
Right.
Okay, so that's real simple. Now, let's say that I did this on margin. So I put up 30%.
Mm-hmm. So you put up $15,000.
I put up $15,000. The broker put in $35,000. I bought $50,000.
Yep.
Now I can sell my shares for $100,000 because they doubled.
Right.
How much money did I make?
Well, presumably you pay off the loan for $35,000, which means you got $65,000 less. You put $15,000 down, so you made $50,000. Does that not agree with your math?
I get $65,000. You're right. Yep. So I sell them for $100,000. I pay off the $35,000 loan. Mm-hmm. I've got $65,000. I invested $15,000 to begin with.
Right. So you just made the same $50,000 we made the other way.
Yep. In fact, I made 4 times my money because I only had $15,000 invested.
Right.
And now I've got 65,000. This is fantastic, right?
Okay. Yep.
So that's leverage for you, baby.
Right.
If it goes up, it's work. And so the reason people use margin to buy stocks is if they go up, you make a lot more money.
You go winning. Yep.
Same scenario. I got $50,000 worth of stock that I sold for 100, but in the first scenario where I paid cash, I had to put in 50 to make 50. The second scenario, I put in 15
to make 50.
And so way different return on investment.
Right.
Okay, that's the good news.
Mm-hmm.
Let's talk about the other side of it. What happens if instead of the stock doubling, it drops in half? So instead of being worth $50, it's worth $25.
Yep. So in the first example where you bought everything with cash, you spent $50,000. You can now sell the shares at half price. You get $25,000 back. You just lost $25,000.
So, okay, that's a problem.
That's pretty about it, but it's straightforward.
It's easy.
You're not indebted to anybody. You took your $50,000 and you turned it into $25,000 without having a party.
Now, what if I did that on margin then?
All right, so I've leveraged it. I've got the $50,000 where I put $15,000 of my own money in and borrowed $35,000, and now I'm selling it back for $25,000, which isn't enough to cover off the $35,000 that I owe.
This is a big problem.
Right.
So you got $25,000 when you sold your shares, but you've got this loan for $35,000.
So you're now $10,000 in the hole, plus you're out all the money you started with yourself.
So I'm like really toast. Well, that's like really bad. So I pay off the $35,000 loan. I have to kick in another $10,000 just to do that because I only got $25,000 when I sold the shares. I invested $15,000 to begin with, so I guess I've lost $25,000 on this.
Right. So it's the same amount of money that the first person lost. The difference is the first person started with lots of cash and ended up they still have half as much cash. In this one, you're now $25,000 in the hole. Like this is money you didn't have.
Yeah, and this is the problem with using margin to invest. You amplify your gains, that's great, but you amplify your losses. You get really, really toast. Now, the example we just gave isn't a real example because you are going to get a margin call before it gets to that point.
Yep.
So your broker's computer is going to look at the numbers in real time, certainly at least once a day, and it's going to say, oh, wait a minute, you now have less capital backing this up. You got to kick in money. We want our money back.
Yep.
And if you aren't able to put your money back quickly, then they sell your shares and do it for you.
Right.
And this is what happens when the stock market is crashing is somebody gets margin called. They can't come up with the cash, so their shares get sold, which drives the price down, and it just keeps going and going and going. Now, I know everyone's watching this going, okay, you're making stuff up here. This never happens. So I'm going to put a chart up on the screen.
Mm-hmm.
And this is a chart of a stock you've probably heard of. It's one of the biggest stocks in the world. It's called Amazon. Have you ever heard of that one, Ted?
The people that never turn a profit, but the stock keeps going up? Those people?
There you go. There you go. They make a lot of money on their computer business, their servers and everything.
Right.
So I did all these calculations myself, so I don't know, they may be wrong. You can fact check me, go to your own thing and figure it out. So since 1998, I counted 9 times where Amazon stock dropped by more than 30%, and there was another time it was 26%. So 10 times since then it's had big drops.
Mm-hmm.
From April to August 1999, it was down 64%.
Wow.
I know. Then we had the big one from December 99 to October 2001. And you remember that, the old .com bubble burst?
Yep.
Those are good times, eh? It went down 95%.
Wow.
So you put in $100, you got $5 left if you sold at the bottom.
Right.
And then, lots of other times. November 2021 to May 2022, down 46%. Then it recovered, was up 27% between May and June of 2022. Then it crashed again. In only 8 days, it went down over 21%. And it was up, and then it was down, and then it was up, and then it was down. And so you wanted me to mention crypto because I know it's your favorite topic. People say, well, crypto, it's really dangerous. Well, yeah, Bitcoin drops 80% every cycle,
right,
or more. And, June of 2022, that, certainly was the case again.
And then the next day it goes up 80%.
And it goes up and down. And my point is, it's not just Bitcoin that does that.
Right.
Amazon did exactly the same thing, had a 95% drop in many others. And I guess if you had just held on, now I don't know when people are actually watching this video, the world may have ended by the time they watch it, but even a blue chip stock, Amazon has a market cap of, I don't know what it is, $1 trillion or whatever.
Right.
even those kind of stocks can go up and can go down. And in fact, between I don't know if I got the numbers here, but May, June of 2022, Amazon stock from peak to the bottom was down 46%. Yeah. So this is not ancient history, only happened in the .com bubble.
All the 25, 30, 40% everybody made during the pandemic has now disappeared.
Mm-hmm. It got
corrected itself
if
out.
you bought at the top and sold at the bottom.
Right.
And so I actually counted up because I know you're a crypto enthusiast.
Yeah,
Since 2010, there have been 33 months where Bitcoin has dropped by more than 10% in 1 month. So that's like a quarter of all the months that Bitcoin has existed. So, and 4 of those months were in 2022, which is the year we're in now. So it's not, again, ancient history.
It's been the last 4 months.
There you go. So back to the question here. Let's think this through logically. Should you borrow to invest? How do you go about making that decision?
And so the question that's most important is, can you afford the risk? And the risk is that you'll lose, right?
It's pretty much that simple. And how do you know whether you could lose or not? Because you're an optimist when you buy these shares. You figure everything's going to go great.
Yep. Well, and there's very little way to predict. I mean, if there was a way to predict easily, then we'd all be zillionaires because we'd all predict it and we'd get it right. And there's so many factors that affect how the market's going to react and how an individual stock within the market's going to have to react.
Yeah, which is why I like to go through examples like Amazon and Bitcoin, all these sort of things, and show that it doesn't matter what stock it is you're buying, there is still the potential for significant losses.
Right. Well, and there's always going to be change. I mean, if that's the one thing that's certain, change is going to come. It's going to go up. It's going to go down. If the whole market goes up or the whole market goes down, some stocks change very little. They're very stable. Some stocks swing a lot.
Well, and the most stable stocks for the last 150 years in Canada have been bank stocks.
Bank stocks, right.
But even you look at the chart of the big 5 Canadian banks, take a look at the March 2020 charts when the lockdowns hit, they all came down quite a bit too.
Yep.
And if you're saying to yourself, wow, this is a long-term hold for me, it doesn't really matter, then I guess it doesn't. But if you're on margin, you got a big problem.
It's a big problem.
And if you're not on margin, it was cash, it's still like, well, if I'd sold it last week, I would have a lot more than this week. Yep. Maybe I better sell now just to get out. You really have to analyze your own psychology.
Well, the average person shouldn't be in the market because they let the media affect their decisions. I mean, you only lose money when you sell. If you keep it forever, maybe it'll come back. Who the hell knows?
Or maybe it'll get completely wiped out. That's
You're back to Nortel, are you?
Yeah, there you go. So, well, because that was the biggest stock in Canada.
Yep, makes a lovely wallpaper now.
Like the largest market cap there was. It was a significant percentage of the TSX, and yet it disappeared. So we're certainly not saying you shouldn't invest.
No.
Because this is an investment show. We're not giving you investment advice. Right. What we are saying is you've got to look at the big picture and don't just be an optimist, because every investor is an optimist.
Right.
By definition.
Otherwise, you wouldn't do it at all.
You wouldn't do it at all. You got to look at the downside as well. So let's take the case then of the person who went to the bank, they got a line of credit, and they decided, you know what, I'm going to put it in that stock or that crypto, or maybe it's starting a business, because that's also an investment.
It is, and it's also a risk.
Also a risk. And let's say that, okay, it didn't go well. You've now got a bunch of debt, and you've got this stock that used to be worth $50 and now it's worth 10. They come in to see you and they say, well, Ted, I got this $50,000 line of credit at the bank, and I now have $10,000 worth of stock.
Right.
What are my options?
Well, and so do you try to sell whatever you have left, the stock, to reduce the debt as much as possible and then negotiate terms? Or are you beyond the point where that even makes any sense? You've got to look at, I got more debt than I can handle, and so you've got to look at possibly a consumer proposal, or a severe case, possibly a bankruptcy.
So in the consumer proposal, well, let's take the bankruptcy option. Yep. So I've got a $50,000 line of credit and I've got $10,000 worth of stocks. What happens in a bankruptcy?
So unless the stocks are being held by some sort of trust, an RSP or something like that, then they're going to be realized, which just means trustee's going to take those stocks, they're going to sell them, turn them into cash, and give each of your creditors their proportional share.
And if I'm in a proposal, if I'm going to do a proposal, So again, same scenario. I got $50,000 worth of unsecured debt. I got $10,000 worth of stock. What are my options there?
Well, so it depends on how sophisticated you get with the negotiation. With a proposal, you're offering to pay back part of what you owe. The general catch is it's got to be more than they get in a bankruptcy. So at least that $10,000. Often it's somewhere around a third of the debt. So it might be you can negotiate to repay that. How much are we saying? A $50,000 loan? You could say, I'm going to pay back $15,000 of it by making payments over time. The creditors might demand that you sell the shares so that they get that $10,000 right away.
And so you could offer a lump sum proposal then.
Yep, you could. You could say, this is all I got. You can have it.
So I'm going to sell the shares for whatever I get for them at market price, obviously, and you get the money.
Right.
If you really think those shares are going to go up in the future, I guess then what you described is what you could do. You could say, okay, I'm going to go to the creditors and I'm going to offer them.
Assuming they let you.
Yeah, $250 a month, $300 a month over the next 5 years, and I can keep the shares. And if the shares do go up in value while I'm in my proposal, then great, I've got more money in my shares now.
Something I could sell to pay off the proposal or whatever.
But if the shares continue to go down in value.
So now you got a double whammy, right?
Right. You've got this payment obligation you've got to make, and the shares have kind of gotten wiped out. So it's a bit of a problem. So your advice would typically be, let's just start over here, get rid of the shares and
presumably do it yourself.
Yeah.
And then perhaps do a proposal on what's left as opposed to doing a bankruptcy.
Yeah.
That's pretty harsh.
Yeah. So, and the bankruptcy, it doesn't just affect the shares. It also affects everything else. So if you've got surplus income or whatever. So we have not had, at least I haven't, a lot of people calling me up, this year saying, oh, I've got these huge losses as a result of investments. Do you think that will become more of a thing throughout 2022 and into 2023?
Well, I'm buying into the recession's coming thing. I predicted early in the year by Christmas, people are going to be looking at mortgage rates at 4.5%, 5% because prime's going to be 2.5%. And so I think things are going to get worse, which generally means the market is going to retreat. But we don't see a lot of people that their insolvencies caused because they borrowed to invest.
Yeah, it's much more likely that, well, my rent went up, I lost my job, I got divorced, I got
paying $200 for a tank of gas.
Right. And that's what's causing the problems. But yeah, I mean, I'm of the view that we're already in a recession. It just hasn't, we haven't had the 2 quarters of negative growth. The numbers just don't match yet. Yeah, they haven't come to it yet. And when you look at the stock market specifically, well, there's quite a correlation between interest rates, what the Fed is doing, all that kind of stuff. Yep. We had the lockdowns and a lot of money printing. Well, that drove all asset prices up. Yep. And then in the spring of 2022, the deleveraging began. Well, there is no more CERB and all that sort of stuff. The business supports aren't there. So the government is not spending as much money. As a result, there's less money sloshing around in the system. Yep. Can't be putting it in the market. In fact, I suspect there are people going, well, I got to pay $200 for a tank of gas. I'm going to sell my stocks, sell my crypto, whatever. Now, final question. You mentioned about things in a trust. So if that $10,000 in stock is in my RRSP, how does that affect the proposal or the bankruptcy?
Well, so if the money's been on deposit for more than 12 months, it's not factored in as what we're going to call a current asset. That means it's protected under the law. You don't have to cash it out. You don't have to sell it. It can't be seized by somebody. It can just sit there. Now, financially, it still may make sense to cash it out to make a lump sum payment to reduce your monthly payments and dealing with the debt. That's a conversation to have with your trustee.
So if I borrowed $50,000 from the bank a year and a half ago, put it in stocks, and now those stocks are only worth $10,000, I could do a proposal. If the bank agrees, I get to keep the stock.
That's right.
But of course, the bank might say, wait a minute, we're kind of getting, we know the money's still in the RSP. We know we can't legally take it, but they may negotiate a little more heavily with you.
They could say, well, the only way we're going to vote in favor of this proposal is if you cash that stuff out.
Yeah, we're not going to take the hit on the downside. And
then you get the whammy that, if you're cashing out funds from an RSP, there's a tax hit too.
Because you take the money out of the RSP, you got to pay tax on it.
Plus, you've also now used up our RSP limit that you won't get back.
So it would probably be better if someone came in and sat down with you and you explained all this.
Probably that would make more sense.
Because there are many different implications. And that's kind of the message of this show here. We don't want to say, well, you should never borrow to invest, or you should always do it.
Right. And don't be confused with thinking that we're starting to talk about investment shows. We are talking about different ways to manage your money so you can deal with your debts. So our focus is always on what's going to be the safe thing for you to do for the future.
Yeah. And so if you do get into trouble and you do have some money in your RSP, but you do have a bunch of debts as well, okay, that's when you want to talk to a licensed insolvency trustee so we can explain, well, here's how the 12-month limit works. Here's how each creditor votes in that situation. Yeah. Here are the tax implications of cashing in an RSP.
There are lots of times when people do all of those other things first and then call us. And so they had $50,000 in RSP. They cashed it off to pay down their debt. They know they got the tax hit. And then they come to see us and say, well, now I owe my taxes. I still owe this much money. And, well, you know, if you've come to see me first, we probably could have protected that money.
Yeah. So it's better to figure out the strategy first. Yeah. And then we can talk. And we can also explain how each different creditor likes to vote and what's likely to happen.
That's
so
right.
I totally agree. Okay. So I will ask you the same question we started with this to finish it off. Should you borrow to invest? What's the thought process? How do you think that through?
You should only borrow to invest if you can afford to lose the money.
So for you, it's entirely a risk assessment.
It's right.
Yep. And I totally agree with that. I think it's all about risk. Know what you're getting yourself into. Things go up, things go down.
Right.
So you got to ask yourself whether it's putting it in the stock market, crypto, a house, a business. What's the worst case scenario here?
Yeah. I lose it all. No, that's not the worst case scenario. Well, the worst case scenario is you borrowed, you lose it all, and now you've got the debt. That's the worst case scenario.
So that's the scenario you've got to walk yourself through. If the business fails, if the stock goes to zero, you know, the crypto goes to zero, which happens every week. If the real estate market corrects, well, okay, maybe the real estate market only goes down 5%. No, it could go down 20 or 30 or 40.
And it's going to correct soon.
And it's, well, we're in the process of it now.
Yep.
So if that happens, what does my world look like?
Right.
And the answer might be, you know what? I'm willing to take the risk.
Okay.
I mean, if I own a house that's worth $1 million and I have no mortgage and I borrow 20 grand from the bank to invest in some speculative thing and I lose it all, oh, well, I guess it's not going to crush me.
Right.
But if I have nothing and I borrow and I lose all that, then I've got a much bigger problem. So you got to look at the worst case scenario.
And don't make the mistake of thinking that if you have nothing, that there's nothing worse than that. You can have less than nothing. We call that debt.
Yeah.
Right.
And that's why the safest way to invest is with cash.
Right.
I don't borrow. I don't do anything on margin because then all I can lose is what I've put in. I can't lose more than what I've put in.
And if you're going to do that, ignore the media. Just buy something that you understand, be confident in it, and, you know, maybe look at it every once a year or something.
Yeah, and that's a very good point. Buy something you understand.
Right.
I mean, I am not a real estate investor. I don't own houses and townhomes and condos and all the rest of it because frankly, I don't really understand it. I don't.
Well, and you have a negative view of what they're actually worth because you think it's a consumer item.
Well, yes. I have no problem with owning a house to live in.
Right. And I agree with that. I mean, you got to live someplace, so you might as well be building equity if you can afford it. If you can afford it, and if you think house prices are going to be increasing during the time period you own it. Right. Obviously, you and I started a business. Yep. Hoyes, Michalos and Associates. With other people's money. That's right. We did. And there was a lot of debt back in the beginning. We did get a line of credit or whatever it was from the bank when we started. Yep. But you and I took the decided risk that, okay, we understand what the risk is. We think we know what we're doing. And I guess we did because here we are 24 years later and we're still green side up, as they say. So it was worth the risk. But there were, many times in the first, 12 years? Well, I mean, we really didn't pay ourselves anything in the first 2 years. Yeah. So you've got to plan on that when you start a new business. Right. That's part of the investment. So you got to look at the ups and the downs and look at the downside risk. So in some cases, like in our case, made sense to do it. Worked. And it worked. Other cases, it doesn't. So make sure you understand what the downside risk. And I think that's how you make that decision. Excellent. Ted, thank you very much. The answer to the question, should you borrow to invest? Well, it's up to you. But make sure you understand the downside risk. Right. And the debt is what gets you into trouble. So there you go. That is our show for today. If you're watching on YouTube, please like and subscribe. If you are listening to this as an audio podcast, well, same thing. Click whatever buttons are there. Helps get the word out. Until next week, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30. And it actually was 30. Look at that. How'd that 29 and a half minutes. That's beautiful. Cool. This week, putting it in the can? This will be probably 2 or 3 weeks from now. Say a show number, so it doesn't matter, right? You can use it whenever.